talked about underwriting a little bit. And this is just out of my own curiosity. Because there's so many different types of lenders, the underwriting probably needs to be a little bit different for each of them because they each, I don't know how they each make money. I mean, the CMBS market, they resell, you resell the loans and you keep recycling money, I guess.
Yeah.
So is it the same for all of them in terms of that process, the way they look at it? Or?
No. That's a great question, and it's just amazing to me how few people really kind of follow the ball on that, and you do, and I know this. Lenders will lend based on the cash that they have.
Okay,
and so let's go categorically through the lending groups. Banks traditionally have money from people who have checking accounts, savings account. They walk in, they open it up a deposit, they walk back out. They walk back in the next day and they want to take a lot of money out. So the money is rapidly going in, going out, coming in, going out. And they've got backups from the feds, and they've got backups with other security for their deposits. But the money is constantly moving in and out quickly. So the type of projects that traditionally, particularly community and local banks would lend on, would be short-term financing.
Okay.
Construction.
Interesting, right.
Mini perm loans. They really don't want to do 10-year fixed rate loans unless they're selling the loan to another group.
Okay.
So because of the fact that, again, look at the bank, people are coming in all day long, that's where their money is. They need to know that they can get the money back, everybody who has a deposit over at the bank. And so the bank's investments are generally by nature short term. Now, the bank also lends to the borrowers and they back into the collateral.
Okay.
And that's another thing that a lot of people may not fully appreciate is most banks lend on a recourse basis, which means there's a personal guarantee. And so they will ask for a tremendous amount of data, and you know this already because you've been through the process with a number of banks that we've worked with. They want a ton of financial data and background on you, the borrower, before they even want to talk about the asset.
Yeah.
And so we walk into the bank and we say, I want to get a loan on that 5-plex or 4-plex down in Santa Monica. You say, great, Mr. Hudson, let's get your financial statement. Well, let's get this, let's get that. And I'll say to the bank, well, look, the financial statement is I've got X amount of net worth.
Right.
And relative to, I know what your underwriting standard is, I've got adequate net worth to buy this and I've got the capacity to buy it.
Okay.
Not so fast, says the banker. I want to see your financial statements, I want to see your tax returns, I want to see your K-1s, I want to do a credit check.
Right.
Because of the fact that I'm really lending to you.
Yeah.
Because you're creditworthy.
Right.
And yeah, the real estate's got to make sense, but you're not even getting to the discussion of the real estate until you pass the test of creditworthiness with the bank.
Right.
Okay?
Yeah.
Because they need to get that money back fast because of where the money comes from.
Yeah.
They can't mess around with a borrower who just is flaky.
Right.
All right, so let's go over to the other end of the spectrum, which is really the long-term fixed rate, which has traditionally been life companies.
Okay.
Okay? Life companies get their money where?
From
selling life insurance policies. All right, life insurance policies traditionally are long-term payments by people like me who have been paying on their insurance for, gosh, I think I bought my first insurance policy in my 20s, so I've been putting money into my insurance for 40 years. And one of these days, I'm going to kick the bucket, and Sandy Hudson is going to pick up the phone and call our agent, Frankie, and say, Jeff's kicked the bucket, we need the money, we want it now. Okay, but meanwhile, Jeff's been putting in the money for years and years and years and years and years and years.
Yeah.
So the life company goes and looks at actuarially what the anticipated payout time frame is going to be on life insurance policies, on whole life policies, on annuities, on term life. They will say, Jeff Hudson will walk in there, age 68, Say, okay, he actuarially has got another 12 years under the hood.
Oh,
Okay, so if Jeff buys insurance right now, we're going to anticipate that we're going to be paying it out in 12 years.
right.
Okay, so they can make investments and they will match the maturity of their investments to the people that they're selling the insurance policies to.
Okay.
Now, they do all sorts of other stuff, obviously. They do. A number of our life companies do property and casualty insurance, too. Well, every 5 years, when the storms come in off of the Gulf, there is catastrophic damage.
Okay.
So those companies have to be a little bit more nimble, those life companies, when they're selling when they are selling policies for property and casualty, than those who are just selling life insurance, long-term fixed-rate life insurance company,
Right.
because they have a little bit more risk.
Yeah.
But again, the way that the money comes into the life company dictates the type of loans that they do. It reflects that.
That's very interesting. I sort of had a question about that, and you sort of answered it with the banks. Because, how do you calculate inflation on a long-term loan that you have on your books? The risk of, I think it was the early 90s, we had 15% inflation.
Right.
How do they protect themselves when that could happen?
Yeah.
Unlikely, but it is a risk.
Yeah, well, they generally will price their loans off of treasuries and off of corporate bonds.
Okay.
So the answer is, how do they know where inflation is going? One, they don't.
Right.
And two, the people that they talk to don't entirely either. But the people that they use to dictate what they're going to charge, which are the feds, they'll look at the treasury bills and they'll say, okay, a life company, life company is like a human being too. It's got a whole portfolio of investments. It's got cash. It's got equities. It owns buildings. It's got real estate loans. It's got municipal bonds. It's got corporate bonds. And so it's a whole tapestry of investments, starting from the lowest risk, which is a treasury bill, all the way up to the highest risk, which would probably be doing joint ventures.
Okay.
A real estate loan is way over on the conservative side, and the pricing that they will charge will be reflected by the amount of risk that they foresee in doing a loan, as opposed to doing just buying a treasury.
Right.
So life companies today are loaning in anywhere from, let's say, 2.5% to 4% for a 10-year fixed rate loan.
Okay.
10-year treasury today is 0.75%.
Okay.
So the life companies are saying, in our portfolio, we're going to have this bunch of, it's generally up to about 10% of our assets in real estate loans, because we are getting anywhere from 150 to 200 basis points more than we would get if we just bought a treasury.
Right.
So again, looking at the whole landscape of their investments, they got their treasuries. They've got a bunch of those. They've got some corporate bonds, and they've got real estate loans, and they've got real estate equities, and they've got other things which are higher risk. And so the price that they charge is all based on the risk that they see compared to just buying a treasury.
Right. Interesting. So that is very interesting.
So they look more to, they'll look at the borrower, they look more to the asset itself and the cash flow. And they're less concerned with the borrower, because they generally don't ask for recourse. Yes, they still want a borrower with a net worth of 2 times the loan. They just want that kind of a borrower, but not because the borrowers are guaranteeing it. They don't want to have that as a risk in their own mind.
Right.
They will also loan at lower loans to value than will the next category we'll talk about, which is the Wall Street conduits.
Okay.
Because they do not want Sandy S. Hudson calling up on the untimely demise of her husband Jeff and being told that the investments, sadly, that Mass Mutual made lost money. And sadly, Mrs. Hudson, we don't have it because our deals went bad.
Right.
Okay, the life companies can't do that. They'd be out of business, and they're backed up into certain respects, but that's the mentality. Lower loan to value, they will charge better rates, they don't need recourse, but they really want high quality. They just don't want much risk. All right, enter in kind of, and there's so many different buckets, but enter in the third kind of bucket, which is this alchemy that was put together on Wall Street some probably 30 years ago, which is the Wall Street Conduit. And basically what they did is they would pool a number of loans together and then securitize them, which means put them in a trash compactor, pack it all down, anywhere from $500 million to $2 billion in this one pool of loans in the trash compactor, and then they will take that to Standard & Poor or Moody's or the rating agencies, and the rating agency will look at that, which is called $1 billion pool, and they will say, okay, the top 80% of the loans are really rated AAA, rated the same as a AAA bond. Okay, the reason is if a loan is, say 70% loan to value, 80% of the 70% is 56%, which means the rating agencies are saying, okay, A-piece buyers, because they are bond buyers in the securitization, it's a 55% loan to value, the risk is very low, you're going to pay X amount of a rate, and it's over treasuries, but it's not quite as high as what it would be for the next tranche. So we chop this thing up. First 80% is the A paper. After that, that's AAA paper. After that, it goes single A, it'll go single B, triple B, and then it'll be unrated. And for each different layer, there are different rates and different risks. And so the last risk, which is really if there is a loss on a property, the top part of the loan is generally going to be getting, let's say in today's market, a 10% return. In exchange for the risk of, if this property goes bad, you're the first one out the door. You will lose. Okay, so back to how the sausage is made. Wall Street basically takes a bunch of real estate loans and turns them into securities, bonds. And those bonds are sold in the secondary market by every Wall Street house imaginable. And you can buy AAAs, you can buy single A real estate CMBS loans, and you can buy unrated, and it's just, it's sold, it is transformed. That's why I call it alchemy. From a real estate loan to a bond.
It's very interesting.
So, all right, that's kind of where the money comes from. So now let's talk about why they lend the way that they do. All right, they are really 100% concerned with cash flow, because a bond holder or a bond buyer buys a bond to get a certain amount of return for the life of the loan. He doesn't want breaks. He doesn't want to know that a tenant moved out, or that there's a recession, or there's this or that. He just wants his payments to come in.
Safe.
Doesn't care about real estate. And the vast majority of the buyers of these bonds, particularly the AAAs and the higher rated ones, they don't even look at the real estate. It's the guys who are the triple Bs or the high risk position that look very hard at the real estate, because they're the first ones to lose. And it's all about the cash flow. And so conduit lending is all based on preserving cash flow no matter what happens. If a tenant moves out, okay, then we've got these trap doors and we've got these systems within the loan such that we have X amount of money which you, the borrower, have already been putting aside every month to carry the property in the event X tenant moves out. And we have this amount of money left in our bucket to put out for the TIs and the leasing commissions, because they're non-recourse loans. We can't, the conduit lenders aren't going back to the borrowers and saying you got to kick in more money.
Right.
They're not. It's non-recourse, and the borrowers won't do it. And so they have to look at properties, and they have to structure their financing that they provide strictly based on preservation and protection of cash flow of that property.
Does that by nature make them less flexible?
Absolutely. You nailed it. It's a very rigid type of a transaction.
Okay.
And it's an expensive transaction if you decide you want to pay it off early, because remember, we had transformed real estate loans into bonds.
Mm-hmm.
And so you've got to, what we call, defease the loan,
Mm-hmm.
which is to turn that bond back into a real estate loan. And so what they would basically do is they would buy back all of the bonds, pay them all off. The borrower would have to pay the cost of that,
Okay.
because the bond buyers were promised X amount of yield over the whole term of the loan. And so to defease the loan, all the bond buyers must be made whole to the same level that they had expected when they made the original bond investment.
Okay.
And so again, that's a real long answer to why do different lenders lend the way that they do, strictly because of what they're told by the people who put money into their institutions.
Right. Okay.
Whether it's you and me with a checking account, is you don't want to go to the bank tomorrow and being told, Eduardo, really bummer, you can't have any money in your checking account.
Right.
There's a run on the bank, and the bank gets closed down when that happens. So that money's got to be available. So their investments generally are fast.
Right. Okay.
Other side, as we talked about, Sandy Hudson calls up, don't want to hear that you're having problems when Jeff kicks the bucket.
Right.
All right, CMBS lenders, the bondholders do not want to hear that pennies went bankrupt.
Right.
They don't care.
Right.
They want their payments.
Okay. Come meet us over at signetinvestments.com. There you'll have access to our full podcast and articles archives. Also, if you subscribe there, you'll get new updates sent straight to your inbox. You can also find us across all social media platforms. Our handle is Signet Investing. Thank you, and invest wisely.